From bad to worse. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have some new data that said the global economy is going to get worse in the months to come. And this is at a time when you want to show you that the market's fixated on the wrong data. They're looking at it and saying, look, the global economy is getting better. I'm going to show you why there's going to be no recovery here and why we're going to see an increase in layoffs. We're also going to look at some leading indicators that are going to validate the data as we're seeing it is going to say absolutely no recovery in the future. And is there actually somebody that I agree with that says the Fed has got this wrong? Well, we'll take a look at that too. Let's first head over to S&P Global, where we picked today's story up with a flash U.S. composite PMI. Now, flash means that we're just seeing a short-term kind of 2-week window before the final report that comes out at the end of the month. So these are just giving us a pulse of where the manufacturing and services sector are. And right now, everyone's fixated on services. It makes sense because the manufacturing opened up first, services came back with a lag, and there's just expected demand that's going to believe that people believe it's going to drive the economy from the services side. This generally doesn't happen. I'm going to show you why the services sector will eventually follow the manufacturing sector lower. It says U.S. output growth, it's 13-month high in May, but divergence, this is a key part, widens between manufacturing and services. This is a red flag, my friends, as company in the U.S. registered solid upturn in business activity during May. This is a summary. I want you to see just how they're spinning this. Say, look, everything's okay. Overall growth and output was the fastest in just over a year, and the expansion was led by problem here, service providers. However, as manufacturers recorded only a slight rise in production, which is slightly misleading because I'm going to show you. Let's take a look first at the manufacturing report of why what we're seeing in the manufacturing sector is an ominous sign for the services sector, which historically tends to lag it. Not only that, heading into the summer months, what do we see a lot of jobs created in? Well, you got it, the services sector. So what we should be seeing here is a surge in services and an upturn in manufacturing. And in fact, we're seeing a downturn in manufacturing. Here we can see from the flash manufacturing subpart of the report that it posted a 48.5 in May, down from 50.2. Now remember, 50.2 is you're just spinning your wheels in the sand. You're not going anywhere. At below 50, it's showing a slight contraction. So what we're seeing here in the U.S. manufacturing sector is it slightly got worse, and that's not a good sign here because, again, last month it just went nowhere. It was unchanged. Now the trend is starting to dip to the downside, and what we can see, it says here, renewed deterioration in manufacturing operating conditions. The decline in the health of the sector was only marginal, which is true, but stemmed from weak demand conditions. This is important, and a reduced need to hold inputs following improved delivery time and lower new order inflows. So none of those parts are good. You hear, wait a minute, fewer new orders, demand deteriorating. This is not what you see in a strong economy that's being led by the services sector at all. And demand conditions weakened notably, however. The fall in new orders was solid overall, the quickest for the 3 months. That is not a good sign because you get a decline in new orders. And what does that mean? Well, if you don't have people, you don't have orders for people to fill, well, you don't need people to do the job. So that being a red flag on that. Overseas sales decreased at a sharp rate. That means a steeper decline in new export orders. Also not a really good sign as well. And what do we note? Firms continue to hire new workers as the availability of candidates improve. So have people heading back into the workforce. What is that telling you? That we either have two things going on here. Either displaced workers are out now that are good workers looking for jobs, or people are coming off the sidelines. Inflation's high, economy slowing, looking for work. But what's interesting to me here isn't that people are coming back into the workforce, is that you see the manufacturing sector willing to hire amid a slowdown. So what you can kind of gather here is they believe this slowdown is transitory and is not going to last, very much longer. So they're wanting to hire. I'm going to make the case again why these new hires are going to be back on the unemployment line before long. because backlogs fell sharply at the fastest rate in 3 years. So again, you don't need people to work. If your new orders are going down and your backlogs are going away, you'll just have people sitting around doing nothing. And here we can see, we're going to flip to the Philly Fed here. We don't have the S&P Global data at the St. Louis Fed database, but we do have new orders from the Philly Fed shown in blue. You'll notice it's very noisy, very typical of this data series, but look at the 4-week moving average of initial claims. When you see a sharp deceleration, a decline in that blue line, particularly when it drops below the horizontal black line, notably, what do you see? An uptick in the 4-week moving average initial claims. And this happens repeatedly. Every time new order demand comes down, initial claims go up. Again, validating exactly what we're suggesting here, that if you don't have orders, you don't need people to work to fill them, and you see it repeatedly over and over again. Now, we see this uptick in new orders back to pretty much the even line, but don't worry, this is really noisy. If this doesn't surge higher, well, that means initial claims will continue to go up. And imagine this, when people are unemployment, they make less money, so they consume less, particularly on the discretionary side, especially in a period of high inflation. But we look at the employment data here, this from Philly Fed. So we know S&P Global said there was a slight uptick in employment, but notably this, you see the employment come crashing down, and with a lag, the 4-week moving average initial claims goes up. You see that here in this mid-70s. You see it in the early 80s. You see it in the early 90s. You see it again in the early 2000s. In the global financial crisis, the only time you really don't see a marked increase in initial claims, there was a brief one, was during that, what was almost a global recession around 2015, 2016. Beyond that, here we are seeing again a steep deceleration in unemployment on the data here, suggesting again initial claims are headed higher. Now, when we pull the two together, let's take a look at the new orders and the employment. And what should we see? Exactly what I've been sharing with you is that as new orders go down, as blue goes down, what do you see with a lag? Red follows, because again, if you don't have orders, you don't need employees to fill them. You see this relationship repeat over and over here. So what's likely that we're going to see here is perhaps maybe a short-term lull to see if that new order growth comes back in the data. If it doesn't, we'll then look to see a whole lot more people hit the unemployment line. And manufacturers signal stronger optimism regarding the outlook for output over the coming 12 months in May, hence why they're hiring. We're going to make the case in a little bit later in the show why that optimism is not going to pan out at all when you see the leading indicators suggesting that indeed the global economy is slowing in a major way. It means new orders aren't coming back. It means backlogs are going to get worked through, and it means that unemployment is going to keep going down and transmit into higher, much higher initial claims. Here we can see the services side. Now, this is what the market's really excited about. It rose to 55.1, signaling a mild expansion. Now, they note this is a strong expansion, but I'll just say a mild expansion at 55. Stronger demand conditions also supported a steeper rise in new business, which is good news. New orders rose at the fastest pace since April 22, with the pace of the expansion exceeding the average. So here you see nothing but good news. Even inflationary pressures remain historically elevated across the service sector in May. But again, this is all due to what I believe is that summertime effect that is coming when the manufacturing sector continues to slow down, when you see people continue to lose their jobs, will spend less on the discretionary side, and that will eventually hit the services sector, which is why the manufacturing sector often, now it doesn't always do this, but it often leaves the services sector by a couple of months. So what we should see here is at some point, the services sector slow down, and if that happens during the summer, that's a huge warning sign. But one thing that you can turn from a warning sign into a big sign is, of course, our CTA-Timer Pro. Now, many people are asked to see if I don't get how to use it. Why is this product so great? Why do you talk about it every show? Let's talk about gold, something all of you agree that you need and need more. But for those of you who trade it, how do you trade it successfully? Well, here, I want to show you. How do you imagine you go back a few months if you knew to buy it right here, and how would you know to sell it up here and pick up a roughly 7.5% gain? Well, let me show you. Going back on 3-2, you notice report said it was 100% short on our fast algorithm. algorithm, 55% short on our slow algorithm, suggesting machines were deeply short gold. The next day, you start to see that fast algorithm start to pick up and short cover, and next thing you know, in the days and weeks fall, it increases there, suggesting that this is when you should be buying and running your other screens to say, look at, this is an opportunity to get in. Had you done that, then what would you have on 420? It starts to sell down, saying, hey, look, if you've already made some money here, raise your stop losses, capture some gains. And that, my friends, is how you use a report and why it's so great. And at $30 a month, it remains a bargain until it gets to 40. Link in the description below, because now let's head over to the Eurozone. As we see this headline from Bloomberg, Eurozone factories flounder with activity shrinking at the fastest pace since the pandemic. And those are words you don't want to hear. Fastest pace since the pandemic. And I think this is something we're going to hear more and more in the data. Would love to get your feedback. Do you think, that we are going to see a major deceleration to the downside? Do you think we're just going to get a soft landing? Perhaps the Feds hope a no landing. Where are you at on this? Put your votes in the comments below. Love to hear from you. As this index, based on surveys of purchasing managers across the region, unexpectedly dropped. I'm going to show you why this was not unexpected at all, to 44.6 in May, further below that 50 level. Now 44 is pretty serious. You're talking a real contraction here. You're talking recession level numbers. You start to get to 45 and under, and this thing becomes serious because it cannot recover at that level without a serious downturn. So this is a warning sign, particularly now when you flip the table here, because the services sector fell, but it's reading at 55.9, signals a robust expansion. So again, the economy and the market is kind of ignoring that, but what they should be focused is on Germany, because it adds mounting evidence of manufacturing woes of Germany, Europe's biggest economy, Europe's biggest manufacturer, are an increasing drag on the wider region, as it is actually part of the biggest problem in that manufacturing report. So again, you think about manufacturing, why is it so critical compared to a services sector job? Because one usually has a lot of hours you're going to work, it usually has potential for lucrative overtime, has benefits, and high pay. It takes skilled workers to manufacture. Someone in the services sector, there's a lot of jobs, that don't require a whole lot of skills, and they don't pay all that well. So you take someone who's losing their job in the manufacturing sector, and their consumption goes away, their discretionary spending goes away. They have to cut how they're handling their money and their spending. It transmits out into the broader economy and eventually hits the services sector with a lag. But it's not just the US, it's not just Europe, it's also, we're seeing signs of Japan, but notice how they're going to spin this to me a little better than I think it is. Japan's PMI signals stronger recovery aided by return of tourists. And here we can note the Purchasing Managers Index of activity in Japan sector rose 0.9 to a record 56.3 in May. So what we're seeing is a global renaissance in services. It's all going on right now around the world. And remember, the key part of this is the global manufacturing sector is slowing. It's starting to contract pretty severely, at least in Europe. When this falls through to the services sector, watch out below, because they're noting here the manufacturing sector added 1.3 to 50.8, making it an expansion for the first time since October 2022. And again, we're only barely just spinning our wheels in the sand. All it's saying is the Japanese manufacturing sector expanded very, very slightly in that month, what I think is not really a big deal at all, because now let's take a look at the leading indicators. And here we can see Saudi energy minister tells oil speculators, you better watch out, because we're having a meeting, and you know what that means. We're cutting production. I keep advising them they will be ouching. They did ouch in April, he said. I would just tell them, watch out. And of course, they don't get it. Saudi Arabia, unfortunately, I understand they have a need. They need to produce oil. The OPEC needs to produce oil to make money because costs have gone up. But what they don't see is higher oil prices right now are a drag on the economy. And despite attempts to cut production, oil prices continue to fall. That is a leading indicator, my friends, that demand in the global economy is coming down in a major way. And despite any attempts for OPEC to raise prices here, maybe it'll be transitory. Maybe you'll see a spike in crude oil prices. Maybe it'll go for a couple of weeks. But last time it reversed as well. And while steep run-up in goods prices was the main impetus to the surge in inflation over the last 2.5 years, the impact of very tight job market is growing and likely to prove more persistent. Well, I forgot to cut the headline of that story off. That wasn't very good. But what's happening here is we're seeing Ben Bernanke say, hey, we got to do something about this labor market. And I want to show you, look, I think I got this a little out of order here, but I want to show you why the labor market is going to actually implode here. I'm not something I want to see, just telling you it's going to, because we know crude oil is telling us demand is coming down. We know new orders are coming down. We know employment is coming down. We know the backlog is coming down. But what about those initial claims? Well, the bond market, as Bernanke should know this like the back of his hand. You see the yield curve showing inverted under that horizontal black line. You see it going in the 80s. You see it here in the 90s. You see it in the 2000s. You see it going into the global financial crisis. You see it before the pandemic. You're seeing it now. And what happens each time? Rising claims, rising claims, rising claims, rising claims, rising claims. And all that tells us is these central bankers remain outright clueless because they're so intent on inflation that perhaps there's one person I'm going to agree with that says they're about to trigger a banking crisis because they're keeping rates too high. As Fed rate path hinges on trade-off between stable banks or prices, there's no economic stability or price stability without financial stability. Luke Crandall, the chief economist at Wrightson ICAP, who's followed the Fed for decades. This has been an unsatisfactory couple of months. I'll completely agree, as FOMC members should think of themselves as central bankers, that is, stewards of the financial system, not just inflation fighters. And he's got it completely right, because the Fed has absolutely no tools to fight inflation. They never really have. The idea that moving the federal funds rate up and down, or their balance sheet up and down, somehow means that prices at the store or the pump or your rent, as somebody's looking at that, says these prices got to go down because the Fed's moving interest rates around, that doesn't translate to the real world at all. In fact, what we can see is financial instability is about to make a big wave into the economy. Again, we're back to that yield curve. Notice when it's inverted, we now, the St. Louis Fed Financial Stress Index, you've seen follow inversions, stress goes higher. Here you can see the global financial crisis, inversion, stress goes to the roof. Here you see prior to the pandemic, stress was already rising from the inversion, and now you see the stress level is going to head a lot higher as this deep inversion of the yield curve eventually starts to steepen. That's a warning sign saying that financial conditions are tightening in the economy in a major way. Banks aren't lending, money's not being created, jobs will soon be lost, and next thing you know, these central bankers are going to have nothing about inflation to worry about, because they're going to bring inflation down at the sacrifice of a banking crisis. And what you're seeing now unfold in a slowdown in the global manufacturing sector, to soon be followed in the months to come by a slowdown in the services sector, means we're also dealing with a global recession. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.